Chapter 2 of 3. 3 taxes, 3 sets of accounts, and 1 worked entry at the end so you can watch every rupee land. By the end, you should be able to look at any invoice and say which account each number belongs to. GST lives in exactly 3 places. Output GST is what you collect on a sale. You credit it because it is a liability. Input credit is the GST your supplier charged you. You debit it because it is an asset. And what you actually deposit is only the difference between those two, which is the whole idea behind a value-added tax. If you collected 1,800 rupees and paid 1,000, you deposit 800, the tax on the value you added rather than on the entire sale. Inside your own state, that splits into CGST and SGST. Across states, it is a single IGST. Same total either way. TDS is tax that never reaches the vendor. On certain payments, contractor work under Section 194C, rent under 194I, professional fees under 194JE, you hold back a slice and pay the rest. And the section you are working under is what decides the rate. So check the current rate for the kind of payment you are making. You credit TDS payable and it stays there until you deposit it. And afterwards, you issue the vendor a certificate because that certificate is what lets them claim the credit. When a customer deducts from you, the entry flips. You debit TDS receivable, an asset exactly like advance tax paid in your name. 3 cases run the other way. Under reverse charge, the supplier charges no GST, so you deposit the tax yourself and then claim the same amount back as input credit. Where you can claim it in full, it costs you nothing in the end, but it still has to be recorded on both sides. TCS, under Section 206C, works the other way around. The seller adds a little on top of specified sales and deposits it in the buyer's name. And e-invoicing and e-way bills add no journal entry whatsoever, yet without them, the document itself is not valid, so they belong in the process, not the ledger. GST and TDS are not twins. GST taxes the transaction and the invoice triggers it, while TDS attaches only to certain payments and is triggered when you pay the vendor or credit them, whichever comes first. A quick test: if the question in your head is whether you sold or bought something, you are in GST territory. If the question is whether you are about to pay somebody, you are in TDS territory. What they share is where they live. Both sit on the balance sheet until they are settled, so neither one is income and neither one is an expense. Here is the whole idea in 3 entries. On a 10,000 rupee sale with 18% GST, you debit receivable 11,800, credit sales 10,000, and credit GST output 1,800. The purchase brings in 1,000 rupees of input credit. Then, at settlement, you debit GST output, credit GST input, and only 800 rupees actually leaves the bank. Read those 3 down the columns. The debits equal the credits every time, and the only cash that moved was the 800. Not 1 rupee of tax touched the profit and loss account, and every figure here is illustrative. Next, in Chapter 3, the filing rhythm, you repeat the 3 ordinary slips that cost real money, where every tax rupee finally lands on your statements, and the whole series recapped on 1 page.